Cushman, back with you. Week 7, I believe it is, of our 8-part series on getting your first or your 10th multifamily property. Good to have everyone here. We've had lots of people coming back every week, so definitely appreciate that. When you do, please go ahead and say hi. And when you do, let us know where you're coming from. Whether it's across the United States or across the world, we've had people from all kinds of different countries, and of course, just about every state in the U.S. It's fun getting to know where everybody is coming from. Hello, Realtor Lexus from Toronto, Canada. All right, we already got someone from outside the country. I hear Canada is a pretty hot market as well. So now, if you missed any of the first seven, I guess, presentations that we did, hello, Miami. Those have been recorded. So go to Bigger Pockets and you can go back to those recordings. Also, for those of you on Instagram, if you can, go switch over to Facebook, because on the Bigger Pockets Facebook Live page is where you're going to see the slides that we have. Oh, hey, House Love from Alpharetta, Georgia. Great multifamily market to invest in, everybody. It's the north side of Atlanta. So again, if you want to see the slides, go over to Facebook. And if you're on Instagram and you can't get to the slides, don't worry about it. They are recorded. You can go get them later. So today we're going to be talking about financing multifamily. We're going to get a bit into the weeds a little bit. We're going to get into the specifics of how you match properties with debt and different strategies, what kind of loans are available. So there's going to be a lot of information to remember. And again, if you can't get it down, it's all being recorded, so don't worry. Let's see. I want to shout out on Facebook, Brenda from Los Angeles. Thanks for joining, and Alyssa from New Jersey. So we got both coasts covered, and Marlon from Washington, D.C. So, all right, I think we're going to go ahead and jump in. We got a lot to cover today. Also, again, if you have a question, please. Oh, I got to stop. We have Jacko from Sweden. I love beautiful, beautiful country. If you have questions, please go ahead and post them in the feed on Instagram, and then also in the comments on Facebook. As long as it's a relevant question, I'll try to work it in as best we can. And then if we've got time at the end, we can go back and cover those. So maybe if I missed it, just feel free to repost. Yeah, we'll try to get as many questions as we can. And we also just had a hello from Israel. So that's super cool. All right. So very brief recap. The first 7 things we covered. Number 1, how do you pick a market? The United States or North America or the world is a huge place. You got to narrow it down to be effective. Number 2, once you have that market, how do you build your team? And that is both in terms of your core team, and then third-party people. How do you put that team together? And number 3 is screening properties, right? So you've done all this work. Now you're getting a good flow of properties coming into your inbox or your voicemail. How do you, if you've got 10 every morning, how do you pick the 2 that are worthwhile? Okay. The next is, now you've got it down to those 2 properties. How do you underwrite them? What principles do you use to underwrite? How do you figure out rent growth, expenses, CapEx, all those kind of things? Once you've done the underwriting and you found a property that you like, how do you write that offer, right? So week 5 was putting together your letter of intent and your offer, and then writing the purchase and sale agreement, which is the legal contract. Then once that happens, now, once you're under contract, it's time to go due diligence, right? You're going to go on site. You're going to tour all the units. You're going to look at the exteriors. You're going to get contractor bids and do all of that. So while you're doing all of that, you're also working on your loan. And that's what we're going to talk about today, financing and debt strategy. And so that's actually the first thing, is what does the timing look like for getting financing? And basically, the minute you get under contract, especially in commercial, you want to start that loan process. And no one said anything yet, but I remember a couple of weeks ago on Instagram that fan was bothering people. So I'm going to go and take a quick 2-second break and turn that off just in case it's a distraction. All right, we're back. So real quick, here's some of the topics we're going to be talking about today. Number 1, and Dwayne, hello from Indiana on Facebook. We're going to be talking about cash, buying properties with cash. Number 2, we're going to talk about buying them with private money. 3, bridge loans. 4, agency debt, which is Fannie Mae and Freddie Mac, and we will define kind of what that means when we get there. CMBS, which stands for Commercial Mortgage-Backed Security. And I'll give you one hint. BS is in the name for a reason. We'll cover that when we get there. We're talking about life insurance lenders or loans. We're talking about seller financing or seller carries, and then also assumptions, right? So we just, in brief amount of time, we just laid out 8 different ways to set up debt to buy a property, right? So if you're, struggling with, I don't have good credit, I can't get a bank loan, or I can't do this, we just went through 7 different ways to finance these things. So yeah, sometimes one doesn't work, but there's lots of others out there. So, and thank you for the hearts on Instagram. And if this is helpful, this is informative, please let us know. Punch the heck out of the hearts on Instagram, and like and share on Facebook. And that kind of helps us know what kind of content to provide and what is hopefully as helpful as possible to everybody. So, all right, let's jump right in. So the first one is cash. And again, you may say, well, that's great, but I don't have cash, Andrew. Well, it doesn't have to be your cash. For those of you who don't know, well, I've done about 2,100 apartment units. And before that, I started as a house flipper. And every flip I did, I bought, well, quote unquote cash, but I used other people's cash. I found a money partner and used their cash. So if you don't have the cash, that's fine. It doesn't have to be yours. Cash just means you're not getting any kind of traditional loan that takes 45 or 60 days to close, right? So when do you use cash? Couple of situations. Number one, and this is not exhaustive, there could be others. Thank you for the hearts on Instagram. One is if you're doing a quick flip, right? If you're buying a fourplex and it's in rough shape, and you're going to renovate it and lease it up and put it on the market to sell, 4 months later, it probably doesn't make sense to go through all the time and expense of a traditional loan if you're just going to get out of it 4 months later. Because also many loans, especially commercial loans, have prepayment penalties, which means if you pay them off too soon, you pay a huge penalty in interest, because the lender doesn't want to do all that work just to have a loan that gets paid off in a couple of months, right? So if you're going to do a quick turnaround, a quick flip, that's when you want to use cash. Another time to use cash is heavy distress. So if you're buying a property that is maybe completely vacant, or maybe it's hurricane damage in Florida or in Houston, flood damage, or just it's been vacant and neglected for 15 years. My first, I think, 3 multifamily acquisitions were bought with all cash, right? Now, again, I syndicated it, which means it wasn't my money. We pooled investors together, and that's how we got all the money to buy it. But we bought them with investors' money. We bought it all cash because this was in 2011 and 2012. Which means back then it was really hard to get financing, right? So on a distressed property back in 2011, you couldn't get a loan to begin with. And then even if we could, the properties were in really bad shape. So that's the time to use cash. But again, just don't have that limiting belief that cash means money in your account. It just means money in somebody's account, right? And if you can get it, you're good to go. And then the third situation here where cash can be an advantage is if you're looking for a really fast close, right? So in today's super competitive market, one way to possibly win deals or increase the odds that you're going to win a deal is to promise a really fast close, maybe 2 weeks. If you're flipping, it might be 5 days. If you're on a commercial property, 30 or 45 days is considered really fast. So if you can pull together cash to close quickly, then that can perceived as a benefit. So again, the 3 main reasons you'd want to use cash right now is if you're doing a quick flip, you're looking at something that has heavy distress, or you're aiming for a really fast close. Let me see here. We've got a few questions. I want to just see if we got any that are. We got hello, Ken from Germany. Stephanie on Instagram says, "Do you ever touch on acquisitions through the property damage process?" Yeah, we did talk. We talked about acquisitions in some of the I think it was steps 2 through 4 is when we talked. It was really kind of focused on acquisitions. So go back and check out those recordings. All right. Now, most of what we're talking about is commercial size multifamily, so that's 5 units on up. But for everybody who is in the 1 to 4 unit range, I don't want to leave you out. So we're going to actually hit that first. And then keep in mind, some of the financing options we're going to talk about don't apply to single family. However, the strategies and the principles apply whether you're doing a duplex or 200 units, right? So don't tune out. This applies to you no matter what. Plus, eventually, even if you're doing duplexes today, someday you're going to go out and you're going to start getting those 20 units and those 30 units, and you're going to want to know this stuff. So stick with us. All right. So if you're buying a 1 to 4 unit single family house or even a fourplex, your main options are cash. We just talked about that. Private hard money. That's basically, that's probably one of the easiest and most popular ways to do 1 to 4 unit properties where, you've got the deal and then you go out and you find some people who are going to just, give you a loan at 8 or 10 or 12% interest. And it's not a hard money lender. A hard money lender loans money as a business. A private money lender is an individual who has money that is willing to loan it to you for a good deal, right? So that's the difference. So private is people hard is a company that they just lend on real estate for really high rates, not based on income. You can go get a conventional mortgage, right? Again, if you're in the 4 units and under, you can get a conventional mortgage where you go to a bank and they're going to check your credit and your income and see if you're qualified and do all of that. That's where you do need to have a good credit score if you're going that route. These other routes don't generally need a good credit score. That's the beauty of it. FHA, that is the, oh gosh, all of a sudden I just blanked out. I think it's the Federal Housing Administration, or somebody on Instagram or Facebook, please correct me and remind me what FHA stands for. I apologize. I don't do single family. I haven't done single family stuff in years. But the important piece is if you are buying your first property and you're going to go do a house hack where you're going to move into it, fix it up and sell, with an FHA loan, you can put 3% down, right? So if you're buying a $300,000 house, you only have to figure out how to come up with $9,000 for the down payment. And of course, there's closing costs and other costs, but it's a way to get into real estate and get your business started with, even if you don't have a whole lot of cash, right? So you can borrow, get a partner, get that $9,000, get the other costs, and get into a property pretty easily with FHA. And again, that's up to 4 units. Does not work on 20 units, but it works up to 4. Thank you for the heart. So hopefully that means this is helpful. The other one is, these last 2 are my favorite. When I was in single family, this is what we did day in and day out. I did not buy a single house with traditional bank financing, right? We always did seller financing and subject to. So seller financing is just like it sounds. So believe it or not, I think something like 30 or 40% of the houses in the United States are owned free and clear. Real quick on Instagram, something about Jen says you can do an FHA loan on a duplex, right? My understanding is yes, you can. So good question. So seller financing is where maybe you're buying a house for $200,000. The person owns it free and clear, meaning there's no other loan on it. So instead of you getting a loan, you say, hey, Mr. Seller, what are you going to do with that 200 grand? And they're like, well, I don't know. I'm going to put it in a savings account and I'm going to earn 0.05% on it, right? Just enough to buy a pack of gum every week. You say, well, hey, what if I make a down payment, you be the bank, and I pay you over time and give you 5% interest rate, something like that. You'll have some income, and so now they have income. They don't have to pay taxes as much. It's a win-win, right? So that's seller financing. Subject to is when you buy a property subject to the existing mortgage, right? And every one of these topics that we're blowing through, we could do an entire hour-long presentation on. So I apologize, we don't have time to get super deep. But there's lots of information. If you go into the Bigger Pockets forums and search any one of these topics, you'll find a ton more detail and information, right? So subject to is you're buying that $300,000 house. The seller has a $200,000 mortgage. Let's say you're going to buy it for $220,000. You give the seller $20,000 in cash, and then you start making the payments on that $200,000 mortgage, and you buy the house, you own the house, the mortgage stays in their name, and you make the payments, right? That's a good short-term solution if you're going to own the property for, let's say, less than a year. In fact, we did that. That was our predominant method of doing single family back when we did that. And if you can find people who are willing to do that, it's really a win-win for everybody. So I know we kind of blew through all 6 of those pretty fast. But those are some of the best options for a 1 to 4 unit in single family. Let me see here. We got a couple people on Facebook. Evie Jones is in the FHA process right now, so good deal. And then Paul says on Facebook, with the FHA 3% down, don't you have to live 100 miles away from any residence you already live in? Again, I don't do a lot of FHA, but so I can't say for sure, but that sounds right. I believe I've heard something along those lines. Again, along those terms. Again, my focus is apartments, commercial size, but I believe you are correct, Paul. So, all right. So bridge loans, back to multifamily. A bridge loan is just like it says here at the top of the slide. It's a short-term loan with higher interest rates, and generally by short-term we mean 1 to 3 years. And candidly, the interest rates on bridge loans these days really aren't that much higher. On good multifamily properties, we're seeing bridge debt come in with low, interest rates in the high 2s and low 3s. So traditionally, bridge loans have been higher priced, but lately the market's gotten so competitive for lenders that the rates have come down to the high 2s. And again, I said, the typical term is 1 to 3 years. If we're doing a bridge loan, we try to get 3 years with 2 1-year extensions, and that gives us up to 5 years. The reason being is if you've got a loan that's only good for 3 years and the market shifts on you, and maybe you can't sell or refinance in 3 years, but that loan is due, that you could get into trouble, right? So that gets into the strategy we're going to talk about in a little bit. But that's why if you get, my recommendation is if you get a bridge loan, try to at least have ways to extend to 5 years if necessary. So bridge loans can be floating rate or fixed. So you can, get it fixed so that it's 2.9% for 5 years, or you can get floating rate. And you say, well, geez, why would I take the risk of floating rate? Most of these are tied to the SOFR, which SOFR, which is a Federal Reserve. Basically, it's an overnight lending rate that is very close to zero and expected to stay there for a long time. So if you take a floating rate loan, you will pay a lower interest rate now, but you have the risk of it going up, right? Well, if it stays low and then goes up towards the end of the loan term, even if you end up paying a higher rate at the end, it basically will in most cases average out, and you're paying the higher interest later versus earlier on when cash flow tends to be more important, right? So, and there's other things you can do. You can buy things called rate caps so that if the rates go up too much, somebody else actually pays the higher interest for you. And again, this could be a whole nother topic, but just to know that, while floating rate loans, a lot of people say, oh my gosh, why would you do that? That's super risky. There's ways to mitigate that. There are ways to mitigate that risk. And bridge loans are definitely a tool that you want in your toolbox to understand, right? Again, another reason you want bridge loans, and thank you for the steady flow of hearts on Instagram. Another reason you want the bridge loans is because most bridge loans either have a really short or no prepayment penalty. So if you're going to sell in 2 years, or maybe you're going to refinance in 2 years, that's when a bridge loan is good, because there's no prepayment penalty, right? You can pay that loan off in 18 months and not owe a penalty. So that's a good time to use a bridge loan. Also, most bridge loans, the entire term, whether it's 3 years or 5 years, is usually interest only. So that helps out your cash flow. And there's a variety of different types of bridge lenders. Sometimes banks will do it. Sometimes debt funds will do it. There's a variety. The best way to get a good bridge loan is to find yourself a really good mortgage broker, and particularly one that specializes in bridge loans. So, all right, let's move on to agency financing. So for those of you who've been hanging around Bigger Pockets for any extended period of time, I'm sure you've probably heard the names Fannie and Freddie, or Fannie Mae and Freddie Mac. These are 2 government-sponsored entities. They were created after the Great Depression, because during the Great Depression, all the banks called everybody's loans due and took the houses. And the government said, okay, this is not a sustainable way to do this. So they created the GSEs, Fannie and Freddie. And basically, Fannie and Freddie are the government's way of backing and securing mortgages in the United States. And that is one of the reasons our housing market has been so strong and relatively stable ever since the 30s, right? So almost 100 years now. There's not a whole lot of difference between the two. Fannie, they kind of shift back and forth. Sometimes one's more aggressive with lending than the other. Sometimes one focuses more on affordable housing than the other. But the nuances are not that. The difference isn't that great, I guess how I should say it, right? And there are some nuances. So that's something to discuss with your mortgage broker. Like, hey, here's my deal. Here's how I want to do it. Is is this a better fit for Fannie or Freddie, right? Because sometimes they like different markets or they don't. Now, requirements for Fannie and Freddie. The good news is they as far, you don't have to have a super high credit score. I think the cutoff is 620, right? So that's a good credit score, but it's not like 750 or anything like that. And as long as you make the cutoff, they don't really care what it is. The other requirement is they typically don't do highly distressed properties. So they want properties that are 90% occupied for at least 90 days. And this is a big one for a lot of people. If you're going to get a Fannie Mae or Freddie Mac loan, you have to have experience, right? So, which means you have to have owned or managed a property similar to the one you're now trying to get the debt on. So you say, well, great. That means I can't get Fannie and Freddie because I'm trying to buy 20 units and it's my first one. So I guess that's out. Not true. So here's the cool thing when it comes to experience for Fannie Mae and Freddie Mac. Number one, it doesn't have to be your personal experience. If you have a partner that has experience with the same properties, and especially if that partner has already gotten the Fannie Mae or Freddie Mac loan, that counts, right? That checks that box. And both Fannie and Freddie, kind of typical of the government, they're very much about checking the boxes, right? As long as you can check the box, then the loan goes through. So one, you're going to have experience, but again, doesn't have to be yours. Also, when it comes to the asset itself, it can't be super high distressed. It generally has to be 90% occupied for at least 90 consecutive days. And there's a bunch of other smaller requirements. Also, you and your partners combined, your net worth has to be equal to the balance of the loan. So if you're buying a property and you're getting a $1 million Freddie Mac loan, your net worth has to be, in order to get it by yourself, your net worth has to be at least $1 million, right? Or if you're getting it with partners, your combined net worth has to be $1 million. So, that gets back to, so when I started getting Fannie Mae and Freddie Mac loans, how I got them is I found a partner who had a very high net worth, so that whenever we signed up for the loans, he signed on it too. Fannie and Freddie said, oh, wow, okay, between the two of you, there's lots of net worth here, and it's like 99% the other guy. And that's how I got my first Fannie Mae and Freddie Mac loan. So if you don't have a good, high enough net worth to get it, that's all you got to do. And that person doesn't even have to be a full partner, right? You can just say, hey, buddy, Uncle Fred, your net worth is $2 million. If you sign on this loan for me, which by the way is non-recourse, right? So that unless we commit fraud, they can't come after you for it. If you sign, I'll pay you a $20,000 fee to sign on this loan for me. That's cool. Fannie and Freddie allow that, right? It's not like the single family world where that kind of thing is frowned upon. In the commercial world, they just want somebody else with a balance sheet to sign on. So it can literally be somebody you pay to do that, right? So don't let these requirements hold you back. There are ways around just about every one of them, right? And then just rules of thumb for underwriting. One of the big, I already talked about 90% for 90 days. Another one that they're going to look at is what's called a debt coverage ratio. And we won't get into the specifics of calculating that. Again, if you go to the BiggerPockets forum and search for that, you'll find lots of information on how to do it. But basically, they're going to want to make sure that your operating income is enough to cover the mortgage payment plus, 25% or so. So if your property makes just enough money to barely pay the mortgage, it's not going to qualify for Fannie or Freddie. So those are some of the things to keep in mind. I know we're moving through this really quickly and it's pretty detailed, specific stuff. But again, we're trying to give all of you stuff that you can go out and take action on. And if you're missing any of it, again, don't worry. It's all being recorded and the slides will be available. We're not holding on to any of this. This is available for everybody who's watching on BiggerPockets to hopefully go out and put to use. So let me see here. We're going to move on. All right. A little bit more on agency financing, and we're going to move through this part a little bit more quickly. And we already talked about the property type. Some other things is the agencies are a little bit more picky about markets, right? They're not going to put a loan on a property in Podunk, Georgia. Believe me, I've tried. They really like the primary markets or big cities like Atlanta, Dallas, Fort Worth, Orlando, all of those kind of places. And so, they prefer bigger cities. Now, they will go down to small cities, we call tertiary cities. You just might pay a slightly higher interest rate, but we use Fannie and Freddie in tertiary markets all the time. The next thing is for the loan size. Fannie and Freddie typically will not go below, I think it's $1 million, right? And sometimes they change those back and forth, and Fannie and Freddie are different at times, but generally speaking, they don't go below $1 million loan, right? So if you're looking for an $800,000 loan, you're going to want to look at bank or bridge or one of these other things. Once you're above $1 million, that's when Fannie and Freddie really come into play. Another great thing about Fannie Mae and Freddie Mac is you can get what's called a supplemental loan. So for any of you who've owned a single family and you've had a regular mortgage, you may be familiar with a HELOC, which is a home equity line of credit, or a second mortgage. A supplemental on a Fannie Mae or Freddie Mac loan is the equivalent of getting a supplemental mortgage on your commercial multifamily property. I'm sorry, of a second mortgage, right? It's called a supplemental. And so that means you can pull cash out without having to refinance or sell. So that's one reason we really like the agency loans is you can pull cash out without having to refinance or sell. And then another benefit to these loans is they're non-recourse, meaning if the whole economy goes down the toilet and rents go down and vacancy goes up and your property can't pay the mortgage and they end up foreclosing, Fannie and Freddie can't come after you for whatever they lose on the loan, unless you commit fraud, right? So that's one of the big appeals of the agency loans is they are non-recourse. A bank loan, you are often personally on the hook for that, right? So let's say you get a $2 million loan on an apartment complex, that whole thing goes bad and the bank loses $500,000. They're going to be saying, hey, Joseph Dunphy on Facebook in Northern New Jersey, you owe us $500,000, and they will come after you for it. So that's a recourse loan. Agencies are non-recourse. They don't do that. So that's one of the benefits of using them. One negative, we mentioned prepayment penalties. The agency loans have something called yield maintenance. Basically what that is when they gave you the loan, they said, okay, we're gonna give Christy on Facebook here a loan at 3%, and that means we're gonna make this many dollars over the next 10 years. And Christy, here you go. And then Christy says, hey, I'm gonna pay this thing off 2 years later. And Fannie Mae says, you need to pay us enough extra interest to make up for that 8 years of interest that we're not getting, right? And it's not quite that simple of a calculation. They don't literally just go through and add up eight years of interest. There's some really funky, complicated, incomprehensible calculus they go through to do it. But just know that if you're going to pay the loan off early by either refinancing or selling, you might strongly consider not going agency because it's going to cost you if you pay that loan off early. The one other thing, though, is you can actually sell it on assumption, meaning somebody takes over that loan and you don't pay it off. That is another option. So, all right, we're going to move on to CMBS loans. We're not going to spend a whole lot of time on this because most of you won't use them. However, as you move into the commercial world, bigger apartments, and maybe even if you do, other commercial properties, especially if you do that, you're going to run into this, and you want to at least know what it is, so that when it comes up, you can have a intelligent conversation on it, right? So CMBS stands for Commercial Mortgage-Backed Securities. One of the benefits, and I mentioned this earlier, for those of you who joined right at the beginning, I think you probably heard me say that BS is in the name for a reason. And I just got a whole bunch of hearts. So hopefully that means, we got a bunch of people who have been here for the last 30 minutes. There's a lot of downsides to these loans, right? They've got very strict prepayment penalties. Paying them off early is even often more expensive than Fannie and Freddie. So this is not a loan to get if you're going to hold for a short period of time. You can't get a supplemental, so you can't pull cash out. And this here says, the slide actually says no assumptions. That's a typo. You can do assumptions, but they are difficult and long, right? And very painful. So it says no assumptions. It really says no. You really should say no. You don't want to do an assumption, right? Now, Kuz on Instagram very adeptly pointed out that interest only, and that is one of the benefits we have listed for CMBS loans here on the next slide. Is that yes, with a CMBS loan, you can typically get many years of interest only payments, right? So that helps your cash flow in the beginning. Although these days that's not that much of an advantage, because most bridge loans and most agency loans also come interest only. So that's not really an advantage of CMBS anymore. And then also you can get long-term loans. You can get 10 years or even longer with CMBS. So if you know you're going to hold for a long time, then CMBS is an option, especially if other loans, if you can't get them. It's better than not doing a deal. But as far as we're concerned, it's the last option. And then I want to go back one slide to another negative of the CMBS loans and what they call lock boxes. And everyone, all you listen, okay, what the heck is a lockbox? Basically, what they do is they force you to take your bank account for that property or for that entity, and they turn it into what's called a lockbox. And it's just like what it sounds, in that the money goes in, and if the CMBS lender gets nervous, or you go into default, or there's all kinds of different triggering events, but basically they can take over control of your bank accounts for that property. So you have to deposit the money in, and then they decide what expenses are going to get paid. And needless to say, you getting paid is not on that list. So that is a huge downside of CMBS. Is if there's a hiccup, if any number of triggering events happens, they can take over operations of your property. And you know what? They're lenders. They really have no clue what they're doing. So once that happens, they're probably going to run it into the ground, and it just doesn't work out well for anybody. So, again, we have BS in red here. We've done one CMBS loan because we just kind of ended up, we had to do it. We ran out of other options. That property's worked out great. But to me, CMBS loans are a loan of last resort. All right, we already did that. So life insurance companies. All right, so you guys are saying, well, wait a second. I thought we were talking about multifamily loans. Why do we have a slide called life insurance companies? Well, part of how life insurance companies make their money is they take all the premiums that you pay for your life insurance, and then they go invest it, and that's how they make a profit. And so one of the life insurance companies' favorite things to invest in is multifamily, because they see it as stable and a good solid yield. So life insurance companies, getting loans from them, they're less stringent than CMBS, so it's typically much easier. The one downside is they are focused on larger deals. So if you're looking for a 5-unit or 10-unit, you're probably not going to be dealing with a life insurance company. But as you scale up, 20, 30, 40, 50 units, especially at today's prices, you might be working with a life insurance company. And again, you're not going to call up State Farm and be like, hey, I'm looking for a loan on my apartment complex. You're going to go to a great mortgage broker who is already going to know some of these people, and you're going to put together a package of your awesome deal, and then that broker is going to take it, and they're going to show it to life insurance companies and all of these other options. So on Instagram, Kuz just asked, do I need a real estate license to be a landlord? Absolutely not. You definitely do not need a real estate license to be a landlord. Let's see. Now, I will. In terms of being a realtor, you don't. There may be some states that have some requirements to be a landlord, but I am not aware of them. And then we have another question on Instagram. Where can I get the slides and presentation? This is being recorded in its bigger pockets. I forget the URL. I apologize. I should have that on hand. But if you search for these, they are being recorded on bigger pockets. So, all right, let's go ahead and move on. Okay, we talked about doing loan assumptions. And this applies for everything, whether you're looking at a duplex or 200 units, right? We talked about, taking over somebody's loan earlier when we were on talking about 1 to 4 units. So if you're looking at 4 units and below, oh, thank you, Nikki. So the recordings are at facebook.com/biggerpockets/live. All right. So for anybody who didn't catch that, the recordings are facebook.com/biggerpockets/live, and all of this stuff will be on there for you. All right. So back to loan assumptions. So we talked about earlier on 1 to 4 unit stuff. If you're taking over the current owner's mortgage, that's called subject to. And in the commercial world, 5 units and above, it's the same process basically, but it's called an assumption. And if you're doing this in the 1 to 4 unit world, you're actually typically not even asking the bank's permission. You just do it, right? In 5 units on up, you actually work with the lender and they qualify you, and then the existing loan stays in place and moves into your name, right? So what this does is, why would you do this? Well, number one, maybe the seller has a really good loan with a low interest rate that's better than what you would get today. Well, it might make sense for you to just assume their loan and take over that loan so you don't have to pay a higher interest rate. Also, it might help you get the deal because by assuming the seller's loan, you are making it so they don't have to pay all those prepayment penalties that we were talking about earlier. And that could be, depending on the size of the deal, that could be hundreds of thousands or even millions of dollars in prepayment penalty that you are saving them. And so you might win a deal by offering a lower price and saying, we'll assume the loan, versus someone who says, no, I want my own loan and a higher price. But at the end of the day, the seller nets more money from you because you're going to assume their loan, right? So again, we just mentioned that sometimes leads to a discount in pricing. And then also, if it's an agency loan, which is what we talked about a couple of slides ago, those loans you can get a supplemental or a second mortgage basically when you buy it. So you assume the loan, you take over that nice low interest rate, you save your seller all those penalties, and then you just get a supplemental to increase the leverage all the way up to 75%. So it's the best of both worlds. Everybody wins, right? There's a flood of hearts on Instagram. I agree. I love those kind of situations because everybody wins, and the best deals in real estate are made that way when everybody wins, right? And if you build a reputation as somebody who looks for ways to make everybody win, you're going to get more deals. And then also on loan assumptions, sometimes the interest only period has already expired, but other times, we've assumed loans that still had a couple of years of interest only left, right? So if you're doing an assumption, you do want to make sure you get a copy of the loan documents and fully understand what you're taking over. But that can definitely be a good way to get deals and have a leg up on some of the competition. All right, so now matching debt with strategy. This is where it gets really, really, really important. All right, and actually, I think we're running a few minutes fast today, which is good. Usually, every other week we've been trying to squeeze it in by the end of the hour. So, if you've been holding on to questions, or I know I've missed a lot of questions especially on Instagram, as they've been scrolling through fast. We've been trying to make sure we get to this. If you have questions that are specific to the topic we're talking about, which is debt and financing and strategy, go ahead and repost those on Instagram. And if you can get to the Facebook Live and do it, number one, you'll see the slides, but two, those comments are easier for me to catch. So if you can do either one of those, I'd love to help answer anybody's questions. So matching debt with strategy. The question you really need to ask is, what is your business plan and exit strategy? So we got a couple examples here, but basically what you want to do is as you're buying your property, whether again it's a duplex, fourplex, or 200 units, you sit and think through like, okay, am I going to hold this for 2 years, 3 years, 10 years? What does that look like? Am I going to try? Do I need or want to pull money out halfway through? Is there something that could change in the market that would make me want to change my business plan? Okay, if I had to sell or refinance and three in 3 years from now, and the market's changed and it's the lenders aren't lending and it's a bad time to sell, are you going to be in trouble, right? So those are some of the questions that you really want to be thinking through, and that's probably one of the most overlooked pieces of multifamily investing, and one of the biggest mistakes that people make is focusing too much on the property and not enough on the debt, right? Your lender is your biggest partner in the deal, and you need to make sure that their interests are aligned with yours, so that you end up with a successful deal. So we'll hit a couple of examples or right here. So example one, this is a property that we purchased. This is actually in Florida. So this is an example of where a bridge loan made a lot of sense. We bought this property. Is built in the 80s. We bought it about 5 years ago. Had a lot of deferred maintenance. I believe occupancy was around 80%, something like that. So it needed a pretty heavy renovation. And again, the occupancy was down in the mid 80s, which means it doesn't qualify for the agency financing. And so we knew that we could get in there and do a significant renovation and get the occupancy up, and because there's a strong market, get the occupancy up and increase the rent. So that is a situation where we know the property didn't qualify for long-term debt, but there was also an opportunity to quickly increase the value of the property. And that is one of the key factors of when to look at or consider using a bridge loan. So we went ahead and purchased the property and did the renovations, increased rent, and then a couple of years later, we refinanced, paid off the bridge loan, and then got long-term financing, right? And this is actually, interestingly enough, this is the property where we ended up having to do a CMBS loan. But fortunately, the property does exceedingly well. We haven't had any problems with the lender. This is a good situation for a bridge loan. If you're, let's say you find 10 units somewhere and 5 of the units are vacant, and you're like, hey, I'm going to renovate these and get them leased up. That's going to increase the value. That's the kind of property that you're going to be looking for a bridge loan on. All right, example 2, permanent debt. So again, when we say permanent debt, what we're meaning is debt that's intended for a longer period. So Fannie Mae and Freddie Mac and CMBS, you can get loans for 10, 12, 15 years. In some cases, you can get HUD loans for up to 40 years. And those HUD loans, they're difficult to get, but you've got a super low fixed rate for 40 years. So if you're buying a property to hold on to it forever or for your retirement, HUD loans are definitely something to look into. They're quite the ordeal to get. It can take 6 months, but if you can get them on the right property, it can be very beneficial. So the picture here is a property that we purchased again in Florida. This was March of this year. It was on average 2011 construction. The property was 93% occupied. It was in a tertiary market of Florida, Fort Walton Beach, but that market is very strong and growing. And we also knew that we want to hold this property for at least 6 years. So it's not a quick turnaround and sell. So because of those factors, we got a 12-year Fannie Mae loan. And you say, well, okay, well, Andrew, wait, you just said you're going to probably sell it in 6. Why would you get a 12-year loan? Here's a couple of reasons. And I picked this one because it's a really good example of, and whether you're doing this with a 4-plex, a 10-unit, or in this case, a 252-unit, this is a really good strategy example of matching your debt with your exit strategy and is setting yourself up for multiple exit strategies in an uncertain market, right? Lots of questions right now about where the market's headed. And one of the best ways to protect yourself against that is properly structured debt. So how do we do that on this property? 12-year Fannie Mae. Why 12 years? Well, the worst case scenario is we know we can just hold it for 12 years, right? And I don't believe this is going to happen, but if the commercial real estate market takes a huge crash, we can wait 12 years for it to come back. And in the United States, if you look over the last 100 years or so, you really have a tough time finding a 12-year period where at the end of 12 years, apartment values are not higher than they were at the beginning of the 12 years period, right? It's one of the beautiful things about real estate is it's one of those, it's a rare asset where if you make a mistake, time heals almost all wounds. So we gave ourselves a 12-year runway in case 3, 5, 6 years from now the market's in trouble. Fine, we can hold on to it. We've got a fixed low interest rate. Another reason we got that loan is because when you go with a 12-year loan with Fannie Mae, they give you, we got 7 years of interest only payments, right? So for 7 years, we only have to pay the interest, which means we have extra cash flow for 7 years. Now, in our case, that the vast majority of that goes to investors. But if it's your property and you don't, and number one, that could let you pay more to investors, or if you don't have investors, you can use that extra cash flow to go buy more properties or build up higher reserves at the property that you bought and that you have that loan on. So the interest only is helpful. Another reason we went with Fannie Mae and we went with 12-year is because we can get 2 supplementals, right? So if you remember, getting a supplemental is the equivalent of getting a second mortgage on your house or doing a line of credit in many senses. So that means, we're increasing rents $400 on renovated units. So that means we're creating a lot more cash flow and a lot more value, and it increases the returns to be able to take some of that equity out in 2 years. So we can get a supplemental and do that. Now, if you go back and remember when we talked about assumptions, we said that, someone on Instagram here just says that, hey, somebody told me that Fannie Mae and Freddie Mac won't lend on a house that needs a lot of work. That's true. That's what we just talked about. Fannie and Freddie are not for distressed properties. They generally like cleaner properties, right? So back to this example, we talked about loan assumptions a little while ago, which is just taking over the existing loan. And if you're willing to do that, you can sometimes get lower pricing because that means you have to bring more equity to the deal and you're saving the seller a prepayment penalty. Well, this loan, our buyer can also get a supplemental, right? So that means not only can they take over our loan with a nice low rate, they can get a second mortgage and bring their leverage all the way up to 75%, which means they don't have to invest as much equity. Therefore, their returns are going to be higher. Therefore, they can pay us more when we go to sell it, right? So, you can tell there's a lot of thought process goes into matching your loan with your property and your strategy. So, if you take away one thing from this presentation is that, all of these different loan types that we went over. And again, I know we went over a lot. These slides are, again, they're at facebook.com/biggerpockets/live. It's all going to be there. So if you missed anything, go back and grab them from there. But the key thing to take away from the last 50 minutes is, number one, know what all of your loan options are, understand them, and then make sure that you match the loan with your business plan for the property. That is the one most important takeaway of everything that we've talked about right now. I've seen, the people that I've seen get into trouble in real estate, one of the biggest reasons is they got the wrong type of loan for the property that they bought and for their business plan. So hopefully what we talked about for the last 50 minutes is made that a little bit clearer for you, or at least broadened your scope and knowledge of what the options are. And you can, again, go to Bigger Pockets and get in the forums, and you could search every one of the topics that we talked about. And you're going to find tons of posts and people asking questions, and you can learn a lot more about that. We have a couple of minutes, so if I missed a question that you had earlier, or if you've just been holding on to it for a while, feel free to go ahead and post it in the Instagram feed or in the comments and on Facebook, and we'll try to grab that real quick. Now, we have one more step in this 8-step series to getting your first or 10th multifamily. So we've picked a market, we built the team, we've screened the properties, we underwrote it, we made an offer, it got accepted. Yay. We did due diligence, we've got our loan lined up, we closed on the property. Now what, right? Once you've closed, that is really where you make your money in multifamily. Yes, you got to buy it right. Yes, you got to do all these things that we talked about. But when you get into multifamily properties, the real money is made and earned in asset management. And that's what we're going to talk about on our final session. Now, it's actually not going to be next week because I have to go visit some properties that we're looking at, which I actually look forward to doing. So it's going to be in 2 weeks, August 3rd, Wednesday, same time. That's when we're going to do part 8. We're going to tie this all together. And we've spent the last 7 weeks talking about basically how do you get these deals and how do you set everything up. But once you have it, then what? Everything out there is almost always focused on getting the deal. But the most important thing is okay, dang, I got a deal. Now what do I do with it? So that's what we're going to talk about next time. I hope to see all of you there in 2 weeks. And in the meantime, get in the Bigger Pockets forums, start, educate yourself. If there's anything that we talked about today that you're like, oh, geez, I don't really know much about that, or what the heck did he mean? Go in the forums, search that stuff. There's tons and tons of information in there. And then if you missed any of the last 7 weeks, go back and rewatch those so that in 2 weeks, when we do part 8, this will all make sense when we tie it together and go over asset management so that 3 years or 5 years or 10 years from now, you're selling your property for 2 or 3 times what you paid for it, hopefully, right? In the meantime, if you'd like to connect, of course, I'm on Bigger Pockets. Please connect with me there. And then you can Google search Vantage Point Acquisitions or Andrew Cushman. Our website will come up and you can contact me through that as well. So everybody, hope you have a great rest of the week. Go out and dig up some deals, make some offers, and next time around, we'll talk about how you manage those. All right, take care.